Well, certainly if you saw the social news out of Kazakhstan today, it would appear that there might be some cause for concern around uranium supply. And I suspect that the stocks may trade higher. For me, that's not necessarily a cause of joy. Given that I believe the uranium stocks will double or triple from here over 3 years, I'm a buyer, not a seller. And given the fact that I'm a buyer, I'd like to see them lower rather than higher. I guess a mark of your enthusiasm for an asset class is when you own a lot of it and you want to see it cheaper so that you can buy more. And in that circumstance, my feeling with regards to the uranium stocks is I wish they would continue their decline rather than renew their ascent. I know that my wishes don't have much to do with the way that the market will perform.
You seem to be right a lot ever since we've talked, but I'm thinking we're going high, fortunately.
Well, Jake, I remind you of my successes, and I don't to try to remind you too often of my failures. The truth is, if you've been around as long as I and you've done as much as I, you've been wrong and you've been right on several occasions. And the truth is, I have enough uranium in my portfolio, and I'm a large enough shareholder of Sprott, benefits many ways, increased prices, so that if I was wrong, and if the uranium stocks took off, it would be okay with as I say, I would prefer to own a lot more, not a little more. And given that that's the circumstance, I would like to see them cheaper rather than dearer.
And mining stocks has been natural resource, an area of your focus. How do you see commodities playing out in 2022? How do you make sense of what's happening, seemingly ever increasing inflation?
Your listener need to ask themselves a question around natural, including gold and silver, but mostly ex-gold and silver. And that question goes, in the next 2 or 3 years, do they expect a recession or a depression? Or do they expect that the continuation of money printing will generate enough liquidity that the economy will continue to limp along the way it's limping? If the answer is door B, which is to say that we don't have a recession or a depression globally, then most of the commodity sector, but particularly the industrial commodities, the stuff of humankind, oil and gas, copper, cobalt, nickel, fertilizer, all those things will do extremely well because demand for this stuff is increasing and society has underinvested in the means of production for a very long time. So your listeners need to ask themselves as to whether the demand side of the picture will be interrupted by a recession or depression. If they don't believe that's the case, my belief, you can buy the industrial commodity, the big ones, the good ones, with absolute impunity. But I would ask your listeners to ask themselves that question first. To be honest with you, I don't know the answer. I have a suspicion. I've been nervous about a recession and mercifully for all concerned been wrong for a fairly long time. I think the question around gold and silver involves a different question. And that question is, how long will it be before negative real interest cause institutional investors to begin to disintermediate their bond portfolio? For the last 40 years, the biggest investors in the world, the pension funds, the sovereign wealth funds, the university endowments, the ultra-large family office, have followed investment guidelines that are roughly 60% equity, 40% debt. Yes, some carve-outs for private equity and stuff like that, but basically 60-40. 60-40 doesn't work in a period of negative interest rates because if 40% of your portfolio is generating a negative real rate of return and you're responsible for pension fund beneficiaries or the operation of a university 20 years from now, it doesn't work. And the people who run those very large funds have enjoyed a 40-year-long bond market. It's made their life very, very easy. They don't like the fact that one decision has gone away. So the question becomes, when does the reality of negative real interest collide with the 40% bondholders of the largest investors? And what do they do with the money? If I'm right, which is to say that investors get tired of a 1.5% return in a world where the purchasing power of their species declines by 6.5%. In other words, if they get tired of losing their beneficiaries 5% a year compounded and divert a fraction of the money that they have invested in debt obligations to precious metals, which is what they did in the 1970s, then I think you're going to have extremely interesting returns in the precious metals. I wouldn't suggest to you or any of your listeners, Jake, that this is a certainty, but I think it's a probability. And I think the rewards associated with that probability are extraordinary. And so I would continue to advocate to your listeners and readers that they devote whatever portion they believe is prudent of their portfolio to physical precious metals in the case of insurance and to precious metals equities for investments and speculation.
So talking about probabilities and how does one prepare? You talked about twofold, a recession, depression versus limping forward, hoping that they're printing enough liquidity to keep from this type of collapse scenario. You said that, you've thought recession, depression, but they've been able to limp it along and you've been, wrong thus far. But let's talk about those probabilities and then the strategy. Do you prepare for both of them and keep a heavy percentage of cash and these types of things? Or how do you what's your advice on strategy?
The recession depression playbook in 1970 was that despite the fact that your cash got eaten up by inflation, that you had to have some anyway. You had to maintain liquidity. You had to make sure that you borrowed non-recourse, which is to say if you had debts, that they were tied to assets rather than tied to you personally. So they couldn't come after your family or your treasurer. Conversely, you had to loan money on a full recourse basis, which is to say, to the extent that you attempted to increase the yield by owning some debt instruments, you needed to place that debt extremely, extremely carefully. Traditionally, too, you need to invest in businesses that have pricing power. You need to invest in businesses that are price makers, not price takers. Warren Buffett wisely points out that well-run business, where there's a substantial difference between the cost of capital and return on capital employed, where they generate utility for their customer, where they have good operating margins, also generate wonderful inflation and are surprisingly recession. So it might be that some of your listeners should consider for some portion of their portfolio one of those boring old ETFs like the Noble Dividend Aristocrats, where you're buying the best companies in the companies that are solvent enough that they've made or exceeded their dividend forecast every quarter for 30 years, in conjunction with other more normal investments for inflation, like precious metals, mining stuff. The most controversial prescription that I always have, and the one that always gets me the most negative feedback from your readers, is the contradiction between saying that your cash holding will depreciate in terms of purchasing power, but you have to own them anyway. You have to own them because in a circumstance where there's liquidity generated volatility, a 2008 style collapse, that sort of retrenchment, if you have liquid assets, the cash will give you the tools and hopefully the courage to take advantage of these types of rapid decline that we saw in the market in 2008, rather than being taken advantage of. Two, someone your age who owns a home with a mortgage, if they get into a circumstance personally where servicing the mortgage is difficult, if they have cash saving, they'll have the ability to save their home, which becomes an important asset over time.
Before we continue, help us clicking that YouTube like button and subscribe now to our channel. This shows the algorithm that you valued this information. And it helps us spread that message. Sharing is caring. And now, let's continue.
Do you want to know one thing about crypto? I made over 3,000% in profit in a few weeks. Fact is, the traditional financial system, the traditional money system makes you poor, not rich. If you want to earn $500,000, $1 million, you have to wait until you're 50, 60, 70 in the traditional financial system, and you probably will still be broke. And you will be old. This is not a sexy combination, as you can imagine. But the question is, how can you start in crypto and make these profits? Where to invest? Where to start? My name is Gunnar and I'm from Germany, as you can hear, and things are a little bit different in Germany. More about that later on. The fact is, there are lots of different cryptocurrencies. It's a gigantic universe where beginners and professionals get easily lost. But there is light at the end of the tunnel. There are 7 key steps you need to follow to become successful in this market. You have to know them, and if you fail one of them, it's literally impossible to succeed in this market. Just an example, one of the key points is your exchange, and one of the biggest are, for example, Binance and Coinbase. These are trusted and well-established exchanges, but, and this is a big but, you won't find the super profitable coins on those exchanges. The unknown super profitable coins that get gigantic profits are not traded on those kind of exchanges. They are traded on much smaller insider platforms that are barely known. And I can tell you what those super secret exchanges are and why they are so profitable. And another super important thing are the right information sources. The point is, the internet is gigantic. There are hundreds and hundreds of YouTube channels, blogs, pages, and much more. And there are also market makers and influencers. For example, Elon Musk, he is not a crypto guy, but the moment he recommended Dogecoin, it went through the roof, to the moon, so to say. But why did he recommend it? Where did he hear it from? He didn't hear it from newspapers. And believe me, he is listening to someone. But you have to know who, and you have to react before he is reacting. This is really important. And these are only 2 of the 7 steps you have to follow in order to be successful in crypto. And if you want to know all of these steps in much more detail, and if you want to have a comprehensive checklist, here's what you should do. There is a link below this video. Click on this link and you will get the opportunity to subscribe to my channel. Click on the link and you will see a video where I explain the next steps. So see you soon. Click on the link now. I'll see you there.